It feels like a perfect storm of geopolitical events is brewing right now. And believe me, it is forcing investors to completely tear up their old playbooks. So, today we're going to break down how this new reality is totally reshaping the world of finance.
Look, to really get a handle on the stakes here, just look at this past month. March was an absolute bloodbath for global markets. I mean, this quote really captures the sheer scale of the chaos. We're talking about a historic wipeout of wealth, and it was all driven by this collision of geopolitical risk and deep economic uncertainty.
All right, so here's our roadmap for today. We're going to start with the market turmoil and get right to the global oil choke point that's at the center of it all. Then we'll dive into what a new investor playbook might look like, see how Asia's fortunes are shifting dramatically, and you know what? We'll even touch on a whole separate drama brewing in the tech world. And then we'll wrap it all up with how to navigate this new normal.
Okay, first up, the manic month. Seriously, it was a period just defined by whiplash headlines and these conflicting signals that left even the most seasoned investors completely scrambling.
Let's just try to wrap our heads around this number for a second. $12 trillion. That's the value that was just erased from global stock markets in a single month. It's a figure that's almost impossible to comprehend, and it really just highlights the profound fear that completely gripped the financial world.
And this slide right here shows you just how unprecedented this shock really was. I mean, it was a bigger hit to the market than the start of the war in Ukraine, and get this, even larger than the peak panic we saw during the COVID-19 pandemic. So no, this wasn't just some dip, it signals this fundamental, deep-seated concern about stagflation and just how fragile our global supply chains really are.
And all this volatility, it's being driven by a classic tug of war. On one hand, you get a headline that suggests a potential off-ramp, a de-escalation, and boom, markets rally. But then, just a few hours later, news breaks of another tanker attack, and everything just plummets. This constant push and pull between hope and fear is really what defines a month.
So much of this conflict really hinges on geography, and specifically, one of the most critical and now one of the most dangerous waterways on the entire planet.
So understanding the potential economic fallout here is absolutely critical. With Iran showing it can hit targets and threatening to expand its operations into the Red Sea, everyone is asking the same question. What's the worst-case scenario for global energy? Just how bad could this get?
Well, analysts are basically gaming out two main scenarios. On one hand, you have a full blockade. That would be, frankly, catastrophic. We're talking choking off over 20% of the world's oil supply. But the much more likely scenario is something they're calling controlled pressure. See, Iran doesn't actually want to destroy demand with, say, $250 oil. Instead, they want to limit supply just enough to keep prices high, punish their adversaries, and of course, reward their allies.
But even a partial disruption carries a massive, massive price tag. Bloomberg Economics estimates that a full-scale, even temporary, blockade could send oil soaring to $140 a barrel, and that would absolutely trigger a severe global economic shock.
So, given this new reality of constant geopolitical shocks, how are you supposed to adjust? Let's break down some expert advice on how you can build a more resilient portfolio for times like these.
Okay, so Dina Tang over at Franklin Templeton offers this really clear three-step strategy. First, zoom out. In an environment with daily shocks, reacting to every single headline is a losing game. Second, and this is a major shift, stop lumping all your international investments together. You have to disaggregate. You got to recognize that a conflict in the Middle East has a completely different impact on Brazil than it does on Taiwan. And third, the holy grail. Find assets that are uncorrelated. The ones that can give you stability when everything else is falling apart.
So, where are those opportunities? Well, Tang points to sectors like China's big push into renewables, which, suddenly becomes even more attractive when oil prices are sky high. She also suggests using tools like single-country ETFs. This is exactly how you execute that disaggregation strategy, by making targeted bets on specific economies that might be insulated from, or maybe even benefit from, the current crisis.
This crisis is creating a massive divergence in Asia. Not every economy is feeling the pain equally. In fact, some were surprisingly well prepared for all of this.
Yeah, this slide right here paints a really stark contrast. On one side, you've got China, which has spent years diversifying its energy sources and building up these massive oil reserves. But on the other side, you have tech powerhouses like South Korea and Taiwan, and they are incredibly vulnerable. Their manufacturing momentum, which was being fueled by the super energy-hungry AI boom, is now seriously at risk from an oil price shock.
And China's resilience? It's not just a theory. I mean, just take a look at this data. The PMI, or Purchasing Managers Index, is a key indicator of economic health. Anything over 50 suggests the economy is expanding. Well, just as this global crisis was unfolding, China's manufacturing PMI jumped to a 12-month high, a huge upside surprise. This shows their economy had a really solid buffer of momentum heading right into the storm.
But hold on, the oil shock isn't the only story rattling investors. At the exact same time, the tech sector was dealing with its own internal earthquake, and this one has nothing to do with geopolitics, and everything to do with a single research paper.
And the source of that disruption is this thing from Google called TurboQuant. It's a breakthrough that could fundamentally change the entire economics of the AI industry. To put it simply, it lets AI models do the same incredibly powerful work while using just a fraction of the memory. Think of it like a massive, massive efficiency gain that just suddenly changes all the rules of the game for chip makers.
The key takeaway here is just the sheer uncertainty this thing created. All of a sudden, investors were completely unsure which type of memory chip would win. I mean, just weeks ago, high bandwidth memory, or HBM, was the clear favorite. Now TurboQuant has thrown that entire thesis into question, causing a massive sell-off in previously hot stocks and adding a whole new layer of risk.
Okay, let's bring it all together. After a month of chaos, conflicting signals, and massive disruption, what are the key lessons for the road ahead? You know, I think this quote from Wei Yao at Societe Generale perfectly captures the mood. When you have this many powerful forces pulling in completely different directions from war to technological disruption, trying to predict the future is, well, it's a fool's errand. The key right now is humility.
So, to sum it all up for you, geopolitical risk is back, front and center. Where a country is located and how prepared it is matters immensely. The old playbook, it's broken. Finding those truly uncorrelated assets is the new challenge. And finally, don't forget that technological disruption, it waits for no one. It will continue to create its own winners and losers, completely separate from the world's conflicts.
And this all leaves us with one final thought to chew on. The world now seems to be defined by constant shocks, from pandemics and wars to huge technological breakthroughs. So the crucial question for all of us is this: is your strategy built to withstand this new reality, or is it still based on the assumptions of a world that, frankly, may no longer exist?